Right now, while you're watching this, the United States government owes more than $40 trillion. Let that number sit for a second. Not 40 billion, 40 trillion. And here's what almost nobody is telling you. The interest on that debt alone now costs more than the entire U.S. defense budget. Ray Dalio has spent his whole career studying what happens next when a country reaches this exact point in the cycle. And his warning isn't about a stock market dip, it's about something much bigger. What happens when a government simply cannot borrow its way out anymore? Today, we're breaking down that warning, and the two assets quietly benefiting from it right now, gold and Bitcoin. Stay with me until the end, because there's one part of this story that most gold and Bitcoin videos completely skip, and it changes how you should think about both of them. Quick note before we dive in. This video is for education only, not financial advice. Always do your own research before making investment decisions. Morning, afternoon, or night for you right now. Drop it in the comments. I always like knowing where this channel reaches. Before we talk about Bitcoin. Forget gold too. Forget the stock market entirely. The real story starts with one word: debt. As of this week, total U.S. national debt has officially crossed $40 trillion, according to the Treasury Department. It hit $39 trillion just 5 months earlier. That's the pace we're talking about. Debt held by the public alone sits above $32 trillion. Add in what the government owes its own trust funds, and you get the full number. Here's the part that should actually worry you. Interest payments on that debt have now topped $1.2 trillion this year. That's more than the government spends on national defense. It's now the second largest line item in the entire federal budget, behind only Social Security. And debt itself isn't automatically dangerous just because it's large. Debt becomes dangerous when servicing it starts competing with everything else the government needs to fund. That's the doorway into Dalio's entire argument, because debt problems rarely explode overnight. They build quietly for years. Then, suddenly, they don't build quietly anymore. Here's our first open question, and we'll come back to it. What actually happens when a government can no longer simply borrow its way out of a debt problem? Keep that question in your head. The answer explains everything else in this video. Ray Dalio's biggest contribution to this conversation is something he calls the long-term debt cycle. The mechanics are simpler than they sound. Economies borrow, credit expands, spending rises, asset prices climb, debt piles up. Eventually, debt grows faster than income, and at that point, policymakers run out of easy options. Historically, governments facing this moment have 5 real choices: raise taxes, cut spending, grow the economy faster than the debt, restructure the debt directly, or lean on monetary policy to make the burden easier to carry. Now here's the part. Nobody wants to say out loud in a campaign speech. Most of these options are political poison. Try telling voters, we need to slash government spending, or we need significantly higher taxes, or get ready for years of slower growth. None of those win elections, which is exactly why history keeps producing a quieter 5th option. Inflate the debt away, not through some hidden conspiracy, just through the ordinary mechanics of money and prices. If wages and prices rise while old debt stays fixed in nominal terms, that debt becomes easier to carry in real terms. But there's always a cost. The purchasing power of the currency itself can erode, and that single sentence is the entire bridge to why gold exists in this conversation at all. Gold has been a monetary asset for thousands of years. It pays no dividend. It has no earnings call. It never issues quarterly guidance. And yet, central banks around the world keep buying it, hand over fist. Why? Because gold isn't a promise from anyone. A bond is a promise to pay. A bank deposit is a claim on an institution. A stock is a claim on a company's future. Gold answers to no one. And that's precisely why it becomes interesting whenever confidence in money itself starts to wobble. Right now, gold is trading above $4,500 an ounce, up more than $1,000 compared to a year ago. It briefly touched levels above $5,500 earlier this year before pulling back, and it's been climbing again through August as debt headlines dominate the news. This is where things start to break down for the old assumption that treasuries are the only safe asset in the world. Because if investors are worried about inflation, currency depreciation, or sovereign debt, gold becomes a form of monetary insurance. But here's a question worth sitting with. What happens when the same investors start looking for a digital version of that same idea? That's exactly where Bitcoin walks into the room. Bitcoin wasn't created by a central bank. No government treasury stands behind it. Its monetary policy isn't set by a committee that meets every 6 weeks. Its supply is fixed by code. There will only ever be 21 million coins. That alone doesn't make it a superior asset. Let's be honest about that. Bitcoin is still extremely volatile. It can fall hard, fast, and without warning. Right now, it's trading around $77,000 after a wild week that saw it jump over 20%, briefly touching nearly $79,500 before a sharp pullback. It's still well below the all-time high near $126,000 set last October. That's the kind of swing gold simply doesn't produce in a single week. Bitcoin also produces no cash flow. Its value depends entirely on adoption, liquidity, regulation, and confidence. But here's the one reason it keeps getting mentioned in the same breath as gold. Bitcoin represents an alternative monetary asset that sits completely outside the traditional sovereign debt system. That's why the two get grouped together, even though they're nothing alike. Gold has thousands of years of history behind it. Bitcoin has existed since 2009. Gold has deep institutional acceptance. Bitcoin is still fighting for legitimacy in parts of the financial world. But both answer the same underlying question. What happens when investors want exposure to something other than government debt and government-issued currency? And that question gets a lot louder once you understand what's actually happening inside the bond market. Here's the part that gets overlooked constantly. When people hear debt crisis, they picture government debt as simply bad. But government debt is also somebody else's asset. Treasuries sit inside pension funds, banks, insurance companies, foreign governments, everyday households. As of the most recent Treasury data, foreign entities alone hold over $9 trillion of U.S. debt. Japan, the United Kingdom, and China together account for roughly $2.7 trillion of that. Interesting detail, China's holdings have actually dropped to their lowest level since 2008, while the United Kingdom's holdings have climbed sharply this year. That's not a random detail. That's capital quietly repositioning. This is where smart money is already moving, long before the headlines catch up. So the Treasury market isn't just a financing tool for the government. It's one of the load-bearing walls of the entire global financial system. If investors demand meaningfully higher yields to keep buying that debt, the consequences ripple outward fast. Mortgage rates climb. Corporate borrowing gets more expensive. Equity valuations come under pressure, and the government itself faces even higher interest costs. That's the feedback loop hiding underneath this whole story. More debt leads to higher interest costs, which leads to more borrowing, which leads to even more debt. Here's a question worth asking yourself right now. Do you think the system can hold at this pace, or is something eventually forced to give? This is exactly why the word escape needs to be handled carefully. Gold isn't an escape from the economy. Bitcoin isn't an escape from volatility. Neither one magically solves a government debt problem. The real argument is more precise than that. If you believe the real value of the dollar could decline over a long stretch because the government has to manage an enormous debt load, then you may want assets that don't depend entirely on that currency, holding its purchasing power. That's the actual thesis. Gold has been the classic hedge for this exact scenario for generations. Bitcoin is the newer, far more volatile contender. For decades, investors were taught that the ultimate safe asset was government debt itself. In a lot of situations, it still is. Treasuries remain incredibly liquid. They're deeply woven into global markets. They remain the backbone of collateral everywhere. But Dalio's framework forces an uncomfortable question onto the table. What happens when the safest asset in the system is issued by the very entity carrying the largest debt load in human history? That doesn't mean treasuries collapse tomorrow. It means the risk calculation just got a lot more complicated. And this is exactly why this matters right now, not 5 years from now. Now let's bring in the institution sitting right in the middle of all of this, the Federal Reserve. Picture a scenario where inflation stays elevated while government debt keeps climbing anyway. The Fed is stuck between two bad options: raise rates aggressively and borrowing costs across the entire economy jump, including the government's own borrowing costs. Keep rates lower, and inflation risks staying sticky for longer. There's no clean exit from that box. This is exactly why monetary policy matters so much to both gold and Bitcoin. When real yields rise and liquidity tightens, risk assets tend to struggle. But the moment investors start expecting easier monetary conditions, the entire environment can flip fast. And here's the detail worth remembering. Markets don't wait around for the actual crisis to happen. Markets price in expectations, weeks or months ahead of time. Bitcoin doesn't need an actual government default to move. Gold doesn't need a failed Treasury auction to rally. Investors just need to believe that the future purchasing power of money might be weaker than they previously assumed. And that reframes the entire next section of this video, because the real story here isn't debt, it's confidence. Every financial system at its core runs on confidence. Confidence that banks will function tomorrow the way they did today. Confidence that governments will honor what they owe. Confidence that currencies will hold their value. Confidence that markets will stay liquid when you actually need them to. That's why financial stress can accelerate so quickly once it starts. People don't need to know the exact day a system breaks. They just need to lose confidence in the direction it's heading. Once that shift happens, capital starts moving from bonds into equities, from cash into commodities, from domestic assets into foreign ones, and sometimes from traditional financial assets into alternative monetary assets. Here's where I want to push back on the loudest voices in this space. If you hear Dalio talk about debt and immediately jump to Bitcoin is going to $500,000, that's not actually the argument he's making. Debt does not automatically equal a Bitcoin bull market. Bitcoin still has to navigate liquidity cycles, regulation, institutional demand, market structure, and competition from other assets. We just watched Bitcoin swing from around $62,000 to nearly $79,000 in a single week, then pull back hard. That's not a straight line to the moon. That's raw volatility. Gold isn't immune to this logic either. It doesn't automatically rise just because government debt is high. Gold has gone through long stretches where inflation-adjusted returns disappointed investors badly. The real thesis is more nuanced than the headlines make it sound. The larger the debt system becomes, the more important monetary policy becomes. And the more important monetary policy becomes, the more investors start caring about currency debasement, real yields, inflation, and actual purchasing power. That's the environment where monetary alternatives become genuinely relevant. And that's a far stronger argument than simply shouting, "Debt crisis, buy Bitcoin" into a microphone. Look back through history for a second. Great powers rarely collapse purely because of debt. The actual process is far messier than that. Debt accumulates, economic growth slows, political divisions intensify. Governments demand more resources from a shrinking pool of trust. Credit cycles become harder and harder to manage cleanly. Eventually, policymakers get forced into choosing between competing priorities they'd rather not choose between. That's why Dalio's framework was never meant to predict one specific crash on one specific date. It's a framework for understanding how financial systems evolve over long stretches of time. And that distinction matters enormously, because the United States still holds major structural advantages. The dollar remains the dominant global reserve currency by a wide margin. The Treasury market remains the deepest, most liquid bond market on Earth. The U.S. economy remains enormous, with powerful institutions and massive productive capacity behind it. So the argument here was never, America is about to collapse. The argument is, the mathematics of debt eventually matter, whether we're ready to face them or not. And ignoring that math has never worked out well for any nation in history. Now let's bring this back to the number we opened with, $40 trillion. We're no longer talking about an abstract figure economists argue about in academic papers. We're talking about a debt burden so large that relatively small changes in interest rates translate into hundreds of billions of dollars in additional annual costs. That's the hidden power of compounding, working against the government instead of for it. A debt problem doesn't need to explode tomorrow to be dangerous. It can simply become progressively more expensive, year after year, until the easy choices run out. This is exactly where Dalio's warning becomes relevant to your own portfolio, not just to Washington. Because if debt keeps growing faster than the economy's ability to support it, something eventually has to adjust. Maybe spending gets cut, maybe taxes rise, maybe growth accelerates faster than expected. Maybe inflation quietly does more of the heavy lifting. Maybe some combination of all of it happens at once. But here's the part that never changes. There is no free solution to a debt this size. Every possible fix transfers the cost somewhere else in the system. And investors who actually understand that can start positioning differently before the crowd catches on. Are you positioned for that shift? Or are you just watching it happen from the sidelines? So what should you actually take away from all of this? First, gold remains the established monetary hedge. Its role doesn't depend on Bitcoin succeeding or failing at anything. Second, Bitcoin is the emerging alternative monetary asset. Its upside comes bundled with dramatically greater uncertainty and volatility, as we just watched this past week. Third, bonds aren't automatically bad just because of this story. They remain an essential piece of the global financial system in most portfolios, but investors need to understand the difference between nominal safety and real purchasing power. A bond can pay you exactly what it promised, while inflation quietly reduces what the payment can actually buy. That's the risk Dalio's framework forces every serious investor to sit with. Fourth, and maybe most important, debt itself is not automatically a trigger for anything. It's a pressure mechanism building slowly in the background. The real question was never whether the United States has debt. It clearly does, more than ever before. The real question is whether that debt keeps growing at a pace that eventually forces major changes in fiscal and monetary policy. Comment below if you're already holding gold, Bitcoin, both, or neither. I read every comment on these breakdowns. Now we can return to the question I raised right at the start. Could gold and Bitcoin become an actual escape route from this? Potentially, but not because either asset is magic, and not because rising government debt automatically sends prices higher on its own. They become interesting because they offer exposure to monetary assets that are fundamentally different from just another promise to pay issued by an entity that already owes more than anyone in history. Gold has already survived countless monetary regimes across thousands of years. Bitcoin is attempting something entirely new in real time in front of all of us. And if Dalio's debt cycle framework proves directionally correct, the biggest issue for investors may not be whether Bitcoin hits some specific price target. It may be whether we're entering a period where preserving purchasing power becomes more important than simply chasing the biggest nominal returns. That single shift would change the entire investment conversation. Because suddenly, the question isn't, how much money can I make? It becomes, how much purchasing power can I actually preserve? And that's a much bigger, much more uncomfortable question to sit with. Ray Dalio isn't necessarily saying America collapses tomorrow. The deeper warning is far more uncomfortable than that. Debt eventually creates constraints. And once those constraints get large enough, governments and central banks are forced into choices they'd rather avoid. Those choices ripple into interest rates, inflation, currencies, bonds, gold, Bitcoin, and ultimately your own purchasing power. So don't fixate only on the headline number. Don't obsess over whether Bitcoin hits a certain price next month. Watch the variables underneath the story instead: debt growth, interest costs, Treasury demand, real yields, inflation expectations, Federal Reserve policy, and most importantly, where global capital is quietly moving right now. Because if Dalio is right, the next major financial shift may not start with a stock market crash at all. It may start quietly inside the bond market, exactly where most people never think to look. And by the time everyone notices, the money may already be gone. If this kind of breakdown is useful to you, subscribe if you want to stay ahead of what's coming, because we cover this territory every week. And share this with someone who needs to see it before it's too late, especially if they still think this is just about Bitcoin's price. The biggest financial moves rarely happen when everyone is watching. They happen before the crowd understands what it's seeing. See you in the next one.